It's getting worse as consumers are in dire shape as the Fed tightens. I'm your host, Steven Van Metre, and thanks for joining me today. And the Fed announced today they're doing something they normally don't do, which is continue to tighten monetary policy into a bear market that is with almost certainty going to lead to a massive recession. And for consumers who think things are bad now, well, they're only going to get worse. Let's pick today's story up where we head over to the Wall Street Journal, who headlines that U.S. retail sales declined 0.3% in May as consumers pulled back at auto dealerships, online shopping, only to spend more gas. Retail sales, a measure of spending in stores, online, and restaurants, fell a seasonally adjusted 0.3% in May. And just so we're clear about what that means, it didn't fall to 0.3%. It actually went negative. Put a minus sign in front of that. It doesn't quite read that way to me, but just so we're clear. From the previous month, dropping from April's revised 0.7% increase, the Commerce Department said today. A sharp drop in vehicle sales due to high prices, low inventory, and rising interest on car loans all played an outsized role in the decline in the month-over-month retail spending. Excluding autos, retail sales rose 0.5%. Excluding gasoline, retail sales spending fell 0.7% in May from April, a sign that high gas prices are taking up a greater share of consumer spending. And that is one of the big issues we're facing. We see in the report, wow, it looks like consumers are healthy, they're out spending, but their spending is being driven toward gasoline, and that's going to take a lot of money away from other discretionary spending, as we're about to look at here soon. Interest rates look set to rise further. Of course, that is the story, always the story. A potential damper on consumer spending in the months ahead as car loans and credit card debt get more expensive. And really, the key to this article is they mean the Fed is likely to raise interest rates. It does not necessarily mean that all interest rates are going to rise. And that is a big differentiator that is not made in this article. Later Wednesday, the Federal Reserve, that's today, wrapped up their meeting, which we'll talk about shortly, as a string of troubling inflation reports in recent days is likely to lead the Fed officials to consider surprising markets with a big rate hike. And Craig Johnson, the president of Consumer Growth Partners, a research and consulting firm, said he anticipates a slowdown in retail spending. We're in a little bit of a watershed in terms of what's going to happen to the economy, he said. The American consumer, she's very resilient, but she's not infinitely resilient. Well, Craig, I think it's not just going to be a little slowdown. It's going to be a big slowdown. And let's make the case for that. Let's go back and talk about that consumer sentiment data we looked at the other day, and now look at what happens when you overlay retail sales, because the consumer's already telling you they cannot afford higher prices. We know inflation-adjusted wages are negative. And sure enough, the University of Michigan Consumer Sentiment Survey in blue, we see here in the great financial crisis heading down. We see it now heading down. And look at retail sales in red on year-over-year rate of change. Notice how it lags. The consumer tries to keep up as they lose confidence, and all of a sudden, with a lag, it heads down. Well, retail sales already starting to slow, only likely to go down substantially more. And what is driving the retail sales at this level? It's debt. Consumers are looking toward their credit cards at a big way. We see that consumer loans, credit cards, and other revolving plans are running at a 15.6% annual rate of change, and that is only seen in rare instances. In this case, we know it's due to inflation. Consumers can't keep up with it, but they're hoping to get wage increases later on. But when those wage increases don't come and higher borrowing costs from the Fed start getting passed on to their credit cards and other revolving debt, well, that means they're going to put a halt to spending and start focusing on debt reduction, and that means the economy is certainly going to get even worse. Higher prices are also giving consumers pause, analysts say, as retail sales aren't adjusted for inflation. While consumers have continued to spend, they're getting less for their money due to rapidly rising prices. The dynamic is also driving an expected shift from discretionary purchases such as furniture and electronics to essentials like food and gasoline. Record prices for a tank of fuel means spending at gas stations likely increased last month, and no doubt it did. And look at one of the knock-on effects is we see that business inventories are rising 1.2%. They continue to go higher. Retail inventories, excluding autos, rise 1.7%. My friends Jeff Snyder and Emil Kalinowski have been covering this in detail on their channel, and it's all about the fact that you're seeing that all this big inventory rise, but if you look at just the retail sales report, you wouldn't get the impression that there's a problem problem here because you say, well, it only went down 0.3% after a revised higher of 0.7 the month before. That's not really a big deal. But what it is a big deal is we're seeing spending get focused on food and energy costs, and because they're so much higher, it's not actually leading to a big drop in retail sales spending. Meanwhile, on other discretionary goods and services, we're seeing inventory levels pile up, and that is a danger sign, leads to disinflation and discounting as even more goods are coming from China here soon as the lockdowns there go away. And companies are struggling with higher inflation, what they say is increasingly hard to pass on to consumers. Some large retailers, such as Walmart and Target, as we've covered, have reported steep profit declines as rising supply chain, wage, and inflation-related costs ate into earnings. Inflation and high fuel prices are also taking a toll on consumer confidence, as we've already pointed out. Last week, the University of Michigan reported that consumer sentiment dropped in June to its lowest point since the inception of the survey in 1940s, telling us exactly where consumer spending is going to go, and it's down. And because it's being driven, as we can see in this chart here, provided by Zero Hedge, the U.S. personal savings in blue is going down as a percentage of disposable income. And what do you notice? Federal Reserve consumer credit outstanding in red rising. So what's happening as paychecks shrink and get smaller and smaller due to inflation, consumers don't want to cut their spending back, so they're turning to their credit cards, again, hoping things will get better. And then when they don't, watch spending drop off of a cliff and focus on those debt payments because interest rates are indeed headed higher. But we'll turn over to the biggest bear on Wall Street, at least at Morgan Stanley. We see Michael Wilson saying growth risks are still not priced in, as over time the lion's share of stock returns is determined by earnings growth if one assumes that valuations are relatively stable. However, they are far from stable and often hard to predict. And he argues that, in fact, 10-year treasuries may be pricing in too much tightening if growth continues to erode and recession risk becomes acute, as Friday's consumer confidence numbers suggest. And why would Michael say that? Well, we talked about this the other day, is that as consumer confidence falls, interest rates also need to fall. And I think he's pointing out that rates are, in fact, just too high. They're responding to inflation and not to what's going on with the economy. But where does he think the market's going? Well, he thinks it's headed lower, and given the growth evidence of slowing growth and the risk to earnings, that estimates could even rise further, which is why we think the S&P 500 is headed toward 3,400 before a more tradable low is in. Well, Michael, that may be good advice. It may actually happen, but we're actually now headed to recession because most people thought the recession was going to show up in 2023, that we may just have a pullback in the markets and see it bounce. But thanks to the Atlanta Fed, we now are seeing signs that the economy is right on the edge of 2 quarters of a downturn and about to see a recession. And here we see today the Atlanta Fed nowcast of real GDP growth hit 0% for this quarter, and suggesting, if that number were to go lower, that actually now we see a recession here in the first half of this year, putting us really squarely with the Fed tightening. The things in the third and fourth quarter are only going to get much worse. And the question is, can your portfolio handle a full-blown recession with the Fed tightening? Well, if you're not sure, be sure to check out Portfolio Shield. I'll put a link up here in the corner and in the description below. Now let's head over and talk about what the Fed did today, because, well, they hiked and big. They went with a 0.75% increase, shocking Wall Street, except for the Wall Street Journal, who seemed to have a little bit of advanced knowledge of what was going on, whereas a 50 basis point hike was pretty much assured when Powell said previously that a 75 basis point wasn't on the table. Well, today it was on the table, and today marks the official start of quantitative tightening, which I want to talk about a little bit. And here we can see that they're going to unwind $30 billion a month of Treasury securities. If they don't have enough to meet that cap, they're going to use their T-bills to bring it up to that, and $17.5 billion of mortgage-backed securities. Now, the popular view is this leads to higher interest rates, but I think a lot of people don't understand the mechanics of it. So I want to touch on this here briefly. Is the way this works is when the securities mature at the Fed. Now, remember, the Fed is holding these mortgage-backed securities and these Treasury securities. So when they mature, what happens? Well, the same thing that happens if you were to own a bond and matures. The person who sold the bond, issued the bond, pays you out. And so what happens is the Fed's going to receive the par value of these bonds back. But remember, the Fed does not have the power to create money, so it neither has the power to destroy money. So where is this money that the Fed's getting going to go? Does it go back to the Treasury? No, it doesn't, because the quantitative easing process started with a customer deposit, and the quantitative tightening process has to end with the money being returned back to the commercial bank. So all the Fed's going to do is start returning this money back to the commercial banks where it actually bought the bonds from originally. Now, what are these commercial banks going to do with this cash, you ask? Well, they have one of two choices. Either they can lend the money out, which doesn't look too good as rates are going to continue rising, or they can buy an interest-bearing security. And with the housing market looking pretty rocky, one can bet they might start buying treasuries. And they might even buy them at the long end of the curve, because these banks are targeting a 5 to 7 year duration of their portfolio. But remember, when a QE process is done, those overnight reserve assets from the Fed are overnight, meaning it's likely the banks are going to start buying out toward the long end of the curve, and that could quickly drive rates down. But what did the Fed really talk about today was the issue? Well, they focused on the job market and inflation and said they remain aggressive, which we're likely to see a 50 basis point hike next month if nothing else changes. But let's take a look at what Fed Chair Powell was focused on. He focused on the consumer price index, telling reporters the issue is the month-over-month change in the consumer price index, which in May posted 1%, is rising, is heading the wrong direction. He needs to see this coming down before he starts to back off, which notably the Fed thinks are not backing off until 2024. But is that the real issue here? Not at all, because we've actually talked about what the real issue is. Let's look at what else he had a problem with, and that is job openings. He said there's effectively too many jobs for the number of workers, and that is creating tight labor conditions. He wanted to see that change, meaning he wants to see the number of job openings drop, and significantly. And he also mentioned inflation expectations were too high, likely referencing the recent University of Michigan report that came out last week. And so what does all that mean? Well, the real story, my friends, is nothing to do with any of those things. It has one thing to do with everything, and that is the price of oil. Because when you overlay West Texas Intermediate crude here against inflation expectations, you'll notice that there's a pretty good relationship that picks up here around 2004, 2006. And you notice how tight it is? Well, what that means is until monetary policy brings crude oil prices down, because where do consumers get inflation expectations from? Well, they drive around, they see those signs at the corner from the gas stations, they see gas prices rising, they think inflation is rising. You bring gas prices down, you bring inflation expectations down, you bring consumer prices down. And what does all that mean? Well, what it means is the Fed wants to see demand drop, they want to see the stock market drop, and if that all is correct, then what you're seeing in the bond market is, why did interest rates fall today and bond prices rise as the Fed raised rates and officially started its quantitative easing program? Because bonds are starting to realize a recession's coming and the Fed's going to make it happen. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.